Are we back, everyone?
Yes, sir.
Okay, excellent. So welcome to the last session. We had conveniently had broken this 4 hour long marathon innings into three parts, and that's the fag end. That's the end. Um, I'm only wondering about what are you going to do after the break, because one can imagine that it must have been a little tiring. Today, a lot of new concepts coming up, and then doing analysis is not that easy, which is what you're going to do now. So I am super duper excited. Let me give you that slide and start the analysis. People, wear your thinking hats. Wear your thinking hats. Here, wear your thinking hats. Um, that's not what you have to think really. I mean, that's a context setting slide where we're saying that how do you. So you remember 6 steps which Lakshya also had raised to kind of put that on during the break. Noting the objective of the analysis. Second is gathering the data. Third is processing the data. That's where we stop. How do you process the data? You have lots of tools, and there are few science graduates here. There are a lot of students who work on Python, and no, not students. I mean professionals who work on Python, teach Python, Tableau, and things. So what I'm trying to say is that all these are tools available to human mankind to process the data faster. Don't confuse what they do with intuitive analysis. That's not what the tool does. Okay, tool is a calculation mechanism. Of course, the seller of the tool will say, no, this tool can think as well, and Excel has a lot of thinking. No, it's just a calculation mechanism. You got to do the thinking yourself, and that is what I am expecting you to do now. There is a data about a company, year one, year two, and year three. Okay, and I want you to look at. Let me change the names. Let me change the names. Give me 1 second. Let me change the year. Year one, two, and three is what we are referring. Give me 1 sec. Year one, year two, and year three, so that there is no confusion. Year one, two, three, and that's about it. Here, I'm sharing the screen now. People, the screen's been shared. There is a company which has this performance matrix, performance trajectory, performance history for the last 2 to 3 years. And in that, what we are referring is 3 questions. You got to read the data. You got to read the questions. You have about 2 to 3 minutes. Use your calculator. That's there on the phone, or in case you want to do it on the Excel, you might need some maths to be done, unless you're very sharp and you can quickly do it on your own. So there are 3 questions, people. Let's debate and discuss those 3 questions. That's how you look at someone's income statement and start making your analysis, your conjectures, your assessment about that fellow. Okay, so your peaceful 2 minutes start now. These are the 3 questions that you have to answer based on the data above. Time starts now. People, 30 more seconds, 30 more seconds. Ten seconds. Okay, all right, people. Let's get back. Yeah, let's get back. How about the question number one? How has the company performed over a period of time? Who's going to answer that? Good, bad, ugly, very good, very bad, outstanding. How has the company performed over a period of time?
It is
Sir,
50% hike,
just
sir.
good.
It's 50% hike.
Good,
Good.
50% hike. Hike in what?
In terms of sales, I'm saying, sir.
How do you calculate, Amudha? How would you calculate this 50%?
I thought it is 2,000 to 4,800, 4,000 to 8,000. So I said,
That's 100%.
oh, it's 100%. Okay, okay, sir.
Yeah. So the delta here is 2800 divided by the base value. So actually it is 140% growth in sales in year one, and thereafter also I'm going to use quick calculation. 8,000. Correct. So 67% increase in year two. Year 2 to 3 and year 1 to 2. So by any standard, the sales have really been amazingly high. It's almost like a startup kind of a thing. Although this is not really a startup income statement that I've borrowed, but what I'm saying is the speed of sales is can put a startup to shame. 4 times in 2 years, everyone would want their salaries to follow this pattern. So I get a sense that all of you are thinking its company has done a good job. Okay, and Pavit is also making a point that there has been an increase in the profit as well, and we can calculate these profits. So it is 672 over 364. So 84% increase here. Oops, 840 divided by 672. And about 25% here. Okay. So in any case, it's a huge increase. It's a huge increase in profit as well. My question was actually on this point number one. Which parameters did you look at if you have to find out who is doing well or who is not doing well? What are the parameters that you looked at? That is what is more critical. Give me the parameters.
I think final profit, sir.
Number one, profit. Brilliant point. That's the first thing that you look at. What is the second thing?
So it's profit before tax.
Now, Vinodhi, you can create a lot of interim profits in between. So you see there are how many profits? Profit number one, profit number two, profit number three, and profit number four. So you can create more interim profits as you suit, according to your managerial interpretation. So one is the final profit. The other really is the sales. Laksh, we'll come to that finer point that you're mentioning. Sales is obviously one of the other things. People, so you look at how is the revenue or sales and revenue are one and the same thing. There is a technical difference. You don't have to worry about that. That's for the chartered accountant to worry. Sales and revenue, also sometimes called as a top line and the bottom line. The bottom line is the last line of the table. This is
The interest cost.
yeah,
Because that is going to play a major role. So whatever profits we earn, the interest cost is the.
Fantastic. I'm going to come back to interest cost or which expenses are more a cause of concern or none or all, etc. So I'm going to go a little deeper at point number 2. Point number 1 is more like a snapshot, that you get a scan of a data and then it just goes off. What are the 2 things that you should not miss? The sales and the profit. Okay, so these are the 2 most important parameter, people. Now
I think, sir, cost of production is also concern. Cost of
now
production.
again, coming back to point that Amita was also raising and Vinodini was also mentioning. Now we can go down to different levels of expenses, because ultimately it's sales less profit. Oh, my bad. Sales less cost is equal to profit. So this cost is made up of manufacturing, admin, distribution, selling, and like Vinodini said, interest as well. Interest is significant because of it's a representative of debt. If interest is high, that means debt will also be high, and if debt is high, then risk is also high, etc., etc. So you can connect the dot. That's the beauty of a human brain. You can connect the dot and make it more holistic. But anyhow, so I wanted to, at point number 1 here, wanted to specify the importance of sales and profit. Most important. Doesn't matter what you are, what you do, who you are, etc. Most important. Okay. Point number 2, people. Now I want to dwell deeper into which expenses are a concern. Which expenses are a concern, if at all. Pavit is a fan of production cost, so therefore he says it's the COGS which is very important. Vinodini is a fan of interest, and therefore she has brought this point up. I am a fan of marketing and sales. Therefore, I'm going to bring this up. Everything is around aggregation model these days. We see either tech or marketing. We're technology and marketing. So some people may be a fan of depreciation. So which expense do you think is a cause of concern? Or you say, no, everything is manageable because profits are hunky-dory. Profits are growing. No problem there. Is there a cause of concern within these 4 or 5 expenses that you see?
So
Yes
it's
or no?
marketing and sales.
Why is that? Why is that? Now, Vinodini, you're
It is
changing
marketing and sales. So
my stance.
because to sustain. So it is of sir. Because see, so to be the same, to continue with the sales, it needs to take the same level of marketing and sales expenses the next year to continue for the company to have the same sales, or at least to be in the, because then the expenses are going to increase, which is going to affect the
Sure,
final profit.
sure, sure, absolutely. So how did you arrive at this conclusion? So marketing and sales could be a wonderful answer. So what you're looking at is more of a conceptual explanation of why marketing and sale, according to you and in your opinion, a very relevant expense. My question to you is, Sini, in this case, according to the numbers which you see, is this a cause of concern? Laksh and Pavit are making a loud point. Rise in marketing expenses excessive. Pavit, how are you calculating this rise? What numbers are you using, combining, doing mathematical operation to come out with the statement rise in marketing expenses excessive? Laksh, why do you say it's marketing and sales expense?
I just feel like just the increase from year 3 to year 1, that's so massive, and that is difficult to sustain over time, because to get in more sales, they'll have to spend more in marketing and sales expense.
Brilliant, yeah, brilliant, absolutely. So what Lakshya is saying, that we can compare the year 3 figure with year 1 figure, and then we can kind of make out which expense is a cause of concern. I'm going to do a little bit of jugglery of numbers, and then perhaps let me ask the question again. The same data being presented in a little different fashion. I want you to first of all not be in a hurry to answer, but first identify how have you got these percentages. Put your mind, your focus. This is not finance, people. This is common sense. So don't disown it just by saying, oh, come on, we are not able to get it because we are, this is finance and we are not anymore. How do you get this 38 and how do you get this 41? Who's going to explain? You have a calculator in hand. You may want to try.
Cost of production on sales, gross profit on sales
So
of that
take
particular
numbers.
year.
Dr. Ashwini, take numbers. So how did you get this 38%?
So 62 on 100. I'm sorry, 1240 out of 2000.
Correct. So let's say if you have to talk about this 38, then what you're saying, Dr. Ashwini, is that 760 divided by 2000.
Right. Yes.
And if you have to talk about this 41, then it is
1968
divided by 48.
48.
So essentially what you've done is converted every figure as a percentage of the total sales. See, what was happening is, as a CEO, when I was looking at the performance and saying that, yeah, profits have gone up, that's very good, sales have also gone up, but how can we bring optimization? Look at marketing and sales, the expense from 80 have gone to 100, like Laksh was also mentioning. I called upon the marketing head. The marketing head said, sir, why are you complaining? Don't you see my sales going from 2000 to 8000? Don't you think with increasing sales, my expenses will also grow? I was like, as a CEO, yeah, what you're saying is right. Then I called upon to check the production guy. He also said, sir, 1240 is nothing. And then it has just become 4800. The sales have also gone 4 times. Now, what's the big deal? So 12 fours are 48. These are expenses have also gone 4 times. I was like, this also is true. So I wanted a matrix. I wanted a number, the way to look at the same number in a way that I can connect everything back to sales. That's what the business generates. So rather than looking in the absolute terms, I've started to look at the relative term. Relative means relative to the sales. Now, for all the years, my sale is 100%. A marketing head cannot put a counter narrative saying, sir, because I'm selling more. Now, every year, we are assuming that you're selling 100 only. And now the point put forth by Laksh is going to be more clear that earlier to sell 100, we were spending 4 rupees. Now to sell something worth 100, we are spending 13 rupees. This 9% fall of profitability, you see, you have to spend more. Why does it happen that your marketing expense starts to go up? What do you think could be the reason? Your marketing expense from 4% has become 9%. Oh, and then to 13, by the way. My God, 4 to 13. Too much. Why do you think that must be happening?
Heavy competition. We
Number
have
one.
to work hard on marketing.
Number one. Number two. Very good. Heavy competition. Classic example.
So maybe the quality is getting reduced, sir. So they need high marketing skills for getting sales to be done.
Brilliant. Totally amazing. When do you need marketing? When there is no demand. Why there is no demand? One could be competition, the other one could be bad quality. Third reason, all of you are doing a terrific job. Third reason why a marketing expense is higher.
Subscription for this marketing agencies are also rising sharply.
Correct. So perhaps the wrong choice of.
So
Go ahead, Vinodini.
So to increase the brand image, sir.
Vinodini, see, if the brand image goes up, like happens with Vivo, who sponsored IPL, happens with Dream 11, who sponsored IPL, and things like those. So there have to be a return on money that should go. What happens if the brand image goes up? The customer must buy. If the customer isn't buying, that means brand isn't going up. You see the point? So what you can say is, and I completely agree with me on that, so it is going to take a while for the customer to come back and buy more. Perhaps right now we are just building the brand. If so, then it's a legible answer. Yes, Laksh.
So one thing could be that the marketing teams have run some experiments that have not perhaps yielded great results. Second is that just the acquiring new customers getting harder for them because those customers like the other brands much better. So getting them on board is becoming a little harder. So initially they might have got customers who were really not happy with other offerings. So now they're after those customers which are slightly happy with the other offerings, so it's becoming harder to get them to use this.
Absolutely. Lakshya. And to complement, yeah, very well answered. So the fourth reason could be, third is what Lakshya mentioned. The fourth could be a wrong choice of marketing strategy. 4 Ps and segmenting, targeting, positioning, etc., price, place, promotion, blah, blah. You might be selling at a wrong place or a wrong product or a wrong price or anything like that. And therefore you have to just pump in money, pump to get that, inventory out, etc. So there could be any reason. So people, you see, that's how an analyst is going to start questioning a thought that enters his mind by looking at the data, that how come marketing is going up? You see, I don't know. Neither the data tells you about the why and how. It only tells you about how much. But that is what you're thinking. Why do you think that is happening? You will have to go back to the data or some other financial information or non-financial to find out the reason about it. People, the process of analysis is back and forth, again and again, back and forth. You can't look at the number and say, oh, fine, yeah, that's conclusive, final, sealed. Doesn't happen. Look at the data, think about it, raise more questions, then look at the data, think more about it, repeat. That's what you got to do. Okay, so people, now with this percentage terms, can you identify the area of concern? Pavit, is production cost an area of concern now? Looking at the second table.
No, sir.
No, not anymore. Brilliant. In fact, it has resulted into saving of 2% of cost from 62% out of 100. Now it's just 60.
Yes.
Pavit, why do you think cost of production would have gone down?
Because as we are doing mass production, the cost is going to reduce.
Fantastic. Economies of scale, number one.
Yeah.
Number two, what could else be the reason? Everyone think aloud. Why do you think cost of production will go down?
So the wages or the salaries?
Can you reduce them? Have you ever been in an organization which has reduced the wages or salaries?
No.
Very difficult. Very difficult. And I wish that you never have to face that situation. Very, very demeaning and detrimental. Why else will the cost of production go down?
Maybe technology upgradation.
When the supply is more.
Very good. Either the supply is more, sometimes, the material, and there is a wide movement in the commodity prices. So look at any aluminum or nickel or copper or a steel buyer. Sometimes there is a fluctuation of 30%, especially with China going the way it is going. China is like almost becoming like an atom bomb.
So we also have come across retail price and wholesale price. When you get the same product in bulk, you will be getting the cost less.
Absolutely. It costs less and the substantial cost saving. So there could be a mass sourcing strategy that a company has adopted, or there could be a reduction in the price of the commodity, or there could be a technology upgradation, or there could be economies of scale, as Pavit mentioned. All of that, people, you got to keep these points open. An analyst is a person who can keep a lot of points open, not conclude in the mind, still be comfortable with the position. You should get restless about it, that I am unable to conclude, is this a production and what? It's okay, relax. Okay, keep those points open. But remember, while you move to, let's say, to analyze depreciation, then you have the open points in your open memory, called as RAM, random access memory, and ROM, read-only memory. ROM is like long-term. You need a short-term quick thing. I want you people to read these two things together and tell me, why is cost of production going down? Is it the commodity price? Is it technology upgradation, or what? Or economies of scale? Just by looking at cost of production, we were unable to analyze it. But now I want you to read it with depreciation. You see the depreciation has jumped up to 8%. When do you think depreciation is more? When do you think depreciation is more?
Value is getting reduced.
Value is getting reduced. Why is the long-term value of the asset going down?
Demand is less.
That is being used more. Very good. Why is machinery being used more?
To meet up the
Production
sales.
is more, sir. Production is more.
Production is more, which means Pavit's reason was the right reason for cost of production going down. It was not technology upgradation. It was not commodity prices coming down. You're just simply producing more. Because had it been a commodity fall, price fall, or a technology, your depreciation would have remained same. Depreciation signals that machineries have been used more. That's why it has gone up. Depreciation is a significance of has a significance of the fall in the value of the long-term asset. So the more you use it, the more it becomes older. That means economies of scale comes out to be the reason here. You see, how do you read the two data points together? Keep some things open, and then when you look at it, that's in academic called as grounded theory. You look at the data, you're grinding the data, you're solving the previous question but raising the new ones.
Sir, a doubt.
Yes.
I know it might sound a little dumb,
No.
but can the depreciation not increase if we have bought new machineries and we have no way of finding that here? I mean, just a doubt.
Think about it. Why would you buy new machineries?
To increase production.
To increase production. And the production has gone up as well. And why the production has gone up? Because the sales are growing, and the sales are growing as well. Well, brilliant point, Dr. Ashwini. Brilliant point. So people, you see, there are multiple, it's like a flow chart. Can this depreciation go because we have bought new machinery? Why? Because the old one was already running at a full percent capacity. You could not operate it beyond 16 hours a day. So you buy new machinery. Now there are two machinery. Two machinery, you'll see more depreciation, and that's what you're seeing. Blah, blah. So you see, it's so interesting to create these conjectures and then trying to find out the reason. So Dr. Ashwini, as you rightly pointed, the information right now on the slide is not sufficient to conclude on any of this. Okay, but think about it, Dr. Ashwini. In any case, the production is increasing. In any case, the output of the factory is going up. In any case, you're buying more raw material to serve the factory. In any case, the worker is being stretched to produce more. In any case, economies of scale will happen. You see the point? So there are multiple factors. One of the factors you increase, you reduce the bottleneck and throughputs, etc., and the overall factory output goes up. Economies of scales are experienced. So both Pavit and you are making a relevant point, but I really like it. And you see, obviously, time's a bit of a constraint. Otherwise, we can also delve deeper. See the pattern. 5% to 8, but then you stagnate at 8. Sales didn't stop. Sales were continuing to grow, 2 to 4 to 8, but there was no change here. Don't you think that's also a cause of concern? That means machinery usage between year 2 and year 3 must be same.
True.
Otherwise, depreciation in year 3 would have gone beyond 8. That didn't go. Why is machinery usage same? But the sales are growing. Where is sales value coming from?
They may have purchased a new machine in between 2 to 3.
If you do that, Pavit, then your depreciation rate of 8% would become 9 or 10.
Okay.
Because we are depreciating it more.
They would have outsourced somewhere.
Brilliant.
Instead of using the machinery, they would have outsourced the.
Excellent. Excellent. That could be the reason. They said that, but enough of enough. I'm not going to produce it in-house. My depreciation, my machinery is already stretched. I'm going to outsource it. And then outsourcing cost is completely put in the cost of production. And this 1% increase perhaps is a testimony of that. So we don't know. We can't conclude. That's what the interesting things are. Yes, Laksh, go ahead.
Perhaps the production managers, they got a little innovative in using the same machinery. So just made their processes a little bit better so that they were getting more optimization from the same.
Correct, absolutely. And also think about it, people, since Lakshya has made a brilliant point. The long-term usage is never like this, is always in batches. What I'm trying to say is this is the scale of business. And this is the typically your fixed costs. Look at rent as an example. And I'm talking about, let's say, a coaching center as a business model. So you have a room being taken on rent, 10,000 rupees. It will suffice for 20 students. So you get to pay 10,000 rent up to 20 students. But whenever there is a 21st student, then suddenly the rent goes up to 20K. And then it's going to remain, because now the second room needs to get full. Up to 40, it's going to be at 20K. Then again, you see, it's a batch level. So who knows, this 5 to 8% is that batch that we are talking about. We don't know. So it's like 5, 10 to 8, and then perhaps after 3-4 years to 11. So these are all open conjectures that we are talking about. Okay, so brilliant performance, all of you, brilliant performance. And I want to come to the third point here. Since the profits have gone from 364 up to 840, is it good or fair to praise the management? Is it fair to praise the management?
Actually, sir, final profit have reduced consistently. Percentage.
Percentage, good point, Pavel.
Percentage.
So,
Sir, and the last percentage is 10%, right, sir? Year
correct.
3.
Year 3 is like 11% roughly. So, so it is going to be, yeah, 8,084. So yeah, roughly 10 point something, 10.5. So this is your 840 divided by 8,000. Pavit, what would you call profit relatively? What is another word for it? Profitability.
Yes, profitability.
Yeah. So so whenever the moment you said profits have been falling, I was like, no. Profits have been increasing and pretty well. Okay. Yes, Laksh, go ahead.
So I would praise them from year 2 to year 1, but perhaps not from year 2 to year 3 to year 2.
That's another dimension. We were very well done, Laksh. Sometimes you look at an overall time series analysis to look at a common view. It was overall, how is this company? But then as in management more particularly, you are not only bothered about year 1 to 3 overall trend line, but you're also interested about learning from the mistake each and every one. You're saying year 1 se 2 alag dekho, and then 2 to 3 you got to look at separately. So that's where Laksh is coming from. So let's bisect the data into two analysis. First analysis, and this is the second analysis. And there you might identify another pattern for it. So let's say, and kind of connecting the depreciation point, in the second analysis, depreciation is not a bother, 8% to 8%. But in the first analysis, it is a bother. It is a big bother from 5 to 8. So profitability, and coming back to the third question, profitability has fallen down by 7%. It's a big fall. The CEO says, Dekha, because of me, your profits have become 840. Earlier, they were 364. I'm going to say as an investor, Mr. CEO, sit down and look at the relative number. Before you became CEO, we were earning 18%. Now, after your leadership, we are at 11%. We are losing 7% every year. The CEO is going to say, oh yeah, really, I didn't notice that. Which expense is responsible? The biggest expense responsible is marketing. There is a fall of 9%. There is an improvement of 2. There is a fall of 3 here. There is a fall of 1. And then there is a saving of 3. So taxes generally is a regulatory thing. You don't really put too much stress. Unless it is at a strategic level where you say, close down that building, open it up in zero tax zone, special economic zones and all. That kind of a disruptive shift that might happen to plan the taxes. But otherwise, taxes is generally, taken out of the financial analysis. So the CEO is going to say, call this marketing fellow and call this depreciation fellow. The factory head and the marketing head both are going to report. Will they call this person who is managing the debt 3 to 4%? It's not a material change. Change and a material change are two different things. Someone, let's say you're earning 70,000 rupees a month and then it becomes 72. What do you tell your folks home? That has your salary gone up? No, yeah, it's a similar thing. Statistically, it's not different, no? So you have to look at the message that is coming from a number. Okay, how do you read a cash flow statement, people? Yes, Laksh. Laksh, you have a point to make?
No, sorry, I forgot to lower my hand.
Okay, no problem. People, wear your thinking hats, huh? Wear your thinking hats. Wear your thinking hats. CFO, CFF, CFI. That's what a particular business had for a particular year. What kind of company does it look like? Is this company expanding or not? You got to think about it. What looks to be driving the company? You got to think about it. Where is the money come from? You have to tell me. And if the same performance continues next year, would the company have to raise next round of funding? You have peaceful 2 minutes. We are left with about 20 minutes. Out of that, we are suitably well placed in time. You have good 2 minutes to look at this data. Time starts now. People, 1 more minute. Okay, all right, people. Let's do it. Yeah, let's do it together. Let's do it together. What kind of company does it look like? Does it look like a mature company to you or like a startup to you? People, operational is day to day, and investing is long term investment. You're spending too much. You're spending too much. And on your day to day basis, you have a cash burn. You see, that's your cash burn. To me, looks like a yes and looks like a startup. But hey, and what's driving the company? Growth is driving the company. Growth at all cost. I want to just ramp up. So if I have one factory, I'm opening up another factory. If I have one warehouse, I'm wanting to open up another warehouse, etc., etc. And where is the money coming from? You have lost 1,200 rupees during the year. Where is this money coming from? This is coming from investors. It could be debt, it could be equity. It could be debt, it could be equity. One of the two. Okay, can you find out by looking at this overall number? No, you have to find out. So if let's say if this is debt, then it will be reflective in the income statement in form of interest, as Vinodini was saying the other time. If it is equity, entire equity, then the interest will be absent. Okay. Correct, Pavit. So it is cash flow from financing. Cash flow from investing and cash flow from operating. Okay.
Sir, I have a doubt, sir.
Yes, Samantha.
Sir, debt and equity, you are saying it is, can it be coming under investment, sir?
Correct. No. That's coming under financing.
Okay. Paying dividend and all, it will be coming under CFF.
Financing only. Anything and everything that you do with your shareholders or your loan providers, that's under CFF, financing.
Okay, sir. And one more thing, how come that positive sign and negative sign is being fixed? Because all our cash flows.
Correct. One is inflow. One is inflow, the other one's an outflow. So Amita, what is happening is, this is business, okay? Business is losing money from operations, buying machinery to fund the expansion. So therefore, net 1200 lost. Who is giving business this money? This business, the investors are giving this money. The investors are giving this money. That's
Okay,
what
sir.
is signaled
Okay.
by this positive number. Okay, and people, there's something called as cash runway. What's a runway in context of an airplane?
It's a path where the flight can. It's a path.
At the time of takeoff. At the time of
Yeah.
takeoff, it's a path where. Yeah, Muta, go ahead. It's a path where.
Where a flight is going to take off. That is, it is in the starting stage and it is going to go further.
It is a
It is going
distance.
to increase its speed,
Correct.
we can say.
It is a distance up to which the flight can remain grounded, after which it must necessarily take off. Because if it doesn't take off after runway finishes, it's going to crash land. Okay, so cash runway means for how many months or how many days can the company survive if the situation doesn't improve. You have these many days, these many months to improve your business model. Otherwise, it's going to crash land. So you are consuming 1200 rupees every year, which means a run rate of 100 per month. How much cash are you left with at the end of the year? 350. That means 3.350 divided by 100, 3.5 months you can continue to sustain without improving your business model. But 3.5 months ke baad, your business is going to crash land because this money is going to go over. Cash runway is a time which a startup has within which it must improve. Otherwise, it's going to crash land. Okay, is this point okay? Tiring session, people. Completely understood. Can we look at the Excel file? Can we look at the Excel file, please? The Excel file that has been shared.
In the database sheet.
Yeah, the base data.
Base
Absolutely.
data. I'm sorry.
Yeah.
Base data.
People, we're going to devote next 10-15 minutes, whatever time is left, on looking at the some of the things like ratio analysis and common sizing and things like those, without putting too much stress on the mind intuitively. So in an ideal situation, we need about 120 minutes to look at this case. We have about 12-13 minutes to look at this case, but nonetheless, you win some, you lose some. So what I have won out of this session, is an amazing galaxy of some of the queries and questions that have been asked. Amazing responses, more particularly in the last half an hour or 1 hour, where everyone was answering, and that was really, really very, very interesting and encouraging for me. What I couldn't do, is to bring this case study to end, but like it says that, the learning shouldn't stop. So after the session, and I'm not kind of closing or giving a farewell speech already, but because typically what happens at 1:45, everyone's going to say end the meeting. So I'm going to kind of make sure that you hear this part. So the Excel file that you have is going to start the discussion in your mind. Okay, that's my intent in the next 10 to 12 minutes. It will not bring things to a conclusion. You need more time for that. You need to get more submerged, in that. And there is a lot of interconnectivity between the data points that you have to worry about, and you have to, get concerned about. So it's a time-consuming exercise overall. What we are going to do in the next 10-12 minutes is to go to that Excel file, look at few things which I think are very critical line by line. In case you have something to talk about basis your observation, we should definitely look at that at a priority, and then we kind of close the session. Okay, does it look like a plan? In interest of time, we got to stay practical. And any other plan that anyone has? Good, I thought so. And I am going to share my screen right away. Can you all see this base data? Can you all see this base data? Plan is okay, Amita. Thank you very much. So you see, people, this is a manufacturing firm. It's a not a very big. The information is in lakhs. So you can imagine that a 40,000 lakh typically means a 400 crore company, which is not a very big enterprise by any standard, but yeah, it's not that small as well. So that's a reasonable number. Okay, the sales from 10,000 have become 40,000. So again, a 4 times increase and things like those. So that's an income statement data. You talk about the production cost, then you talk about the selling and marketing and general expenses, then you talk about depreciation, interest, and then the tax one by one, and gradually you come down. Then in terms of the balance sheet, you have long-term assets, you have some cash in hand, you have some people who needs to pay to you. And then there is some inventory that you're holding in hand. This is the inventory which is inclusive of raw material and WIP and finished product. Equity, reserves, long-term borrowings, and current liability. That's a very, very basic structure. This is what the owners contribute. This is what business generate from the activities. This is like loans, etc. And these are like operational payments still due. Got it, people? That's a base data, huh? That's a structure. Now, I had some questions in mind, and I'm looking from the point of view of a bank as a stakeholder. Should I give loan to this company or not? So what are the 5 things I got to check? Who's going to repeat those 5 things? AVSLV. Something like that.
So it's the
APSLV,
activities
something
of,
like.
so it's the activity,
Very good.
liquidity, and it's the activity, liquidity,
L.
the leverage. It's
Or
the leverage,
solvency. Yeah, fantastic.
solvency.
Very good. Very good.
Then
And the 4th one,
it's
valuation.
profitability, sir. Profitability.
Absolutely. Brilliant. Brilliant, Vinod. Brilliant. So we got to find out these 5 things about this business. How are we going to do that? We dig some base data. Then we start processing the data. Then we analyze it, blah, blah, blah. So the base data is already given to you. Okay. What we got to do is to kind of learn how the common sizing is done, people. So there are 2 ways to do the common sizing, and I want you to observe this very carefully first, and then you can replicate it at your end. So so one common sizing is almost like a vertical common sizing, where we saw that in the slide as well, that you want to express everything as a percentage of that year's sales. So let us say is equal to, you don't have to do it with me. You have a worksheet which has the solution also. Okay, and deliberately it has been given. You have to learn how to do it. So is equal to, go to the base data, COGS of a particular year divided by sales of that year. Okay, and you can copy paste. The formulas will get copy pasted. Okay, and likewise you can draw it. Anyone who is a little more tech savvy on the Excel would know this dollar function, and that will make our life much simpler. So I am not going to tell you about this dollar function right now. You fix this up. You put a dollar and then the relative copying, etc. becomes better. But the key point here is that a 41% would typically mean D7 divided by D3. D7 divided by D3. Fair enough. So people, that's how you're vertically common sizing. Everything in income statement is converted as a percentage to the sales. In terms of the balance sheet, everything is converted as a percentage of total assets. So I go to the base data, you have fixed assets divided by total. That's it. And share it. People, remember we said something about the marketing expense for the startup, we were discussing on the slide. Let's see what is the situation here. The marketing expense 4, 9, and 13. Oops, looks like those figures are from this table only that you've analyzed. You see the production cost of Pavit. So Pavit was a fan of production cost 62, became 60. Cost of production, economy is kicking in. Dr. Ashwini had pointed out that this 8% is falling, is not increasing, it's same. So is it because of a new machinery? So this is exactly the same data that we've analyzed. I want you to observe this and tell me, what do you make of this line? Look at inventory. In year one, inventory was 13% of your total assets. Now inventory is 25% of your total asset. What does it reflect? What does it give you a hint about?
Any new investments made, sir?
Perhaps you've opened up another warehouse and therefore you have bought more raw material, bought more finished goods, you're ramping up. What else can it signify?
I think so better inventory management is required.
Correct, absolutely. Too much. I mean, out of your 4 rupees, 1 rupee is blocked in inventory, which is a usable and a rotatable asset. This is too bad an inventory. Okay, what could be the reason? What else could be the reason, Pavit? Why is inventory getting accumulated?
Maybe the raw material right now they are getting at lower cost. So
therefore, they are trying to save. That's a speculative purpose that tomorrow nickel could become very expensive. Let's buy it today. A lot of traders do it. Okay, what else could be the reason?
Maybe the production is also becoming low, sir.
Then inventory would go down if production is low.
Probably the design which they have already in the market, it has been, the customer preferences has changed. So it may be a dead inventory.
Brilliant. The quality of the product or the quality of the design of, overall as a product, your stuff is not selling. So you're producing something, but you're able to sell something else. So there is a huge non-movable or non-fast moving item which is getting stored somewhere. We don't know. Just by looking at this number, we don't know. We have to look at other things as well. Okay. So people, that's the yellow table, which can throw up a lot of interesting insights. I want you to look at the pink table. There's another way to look at the data. And this time, I am not going to look at the data in relation to sales. I want to look at every data point in relation to its own historical, which means I want to find out how much has sales of second year as a percentage of the first year. And allow me 1 second. D3 and C3. Okay, I get it. Yeah. People, what I've done is this time when I'm creating this pink table, this is also like a trend series analysis, which is also called as a time series analysis. We are saying let the base year figures be 1. We can also say it as 100. what has been the percentage change or an absolute change in that particular figure over a period of time. So now I want you to kind of look at the inventory. Okay, give me 1 sec. Give me 1 second, and that inventory point that we have been making so vehemently will get clear now. Look at the inventory piece. If inventory was 1 rupee, now inventory is 7 rupees. That means the inventory has gone up 7 times over a period of 2 years. Right? So what? So if sales have also gone up, sales have gone up only by 4 times. You see the relative speed of increase in inventory compared to increase in sales is almost 7 by 4, almost 1.75 times. Inventory is growing much faster. This kind of a table I'm referring to as a pink table is a table where you are not bringing sales or any other common base every time into picture. And this pink table is not to compare inventory with account receivable or with anything, or to compare tax with interest. All the figures of the base year are made equal to 1. And then we look at how is the overall pattern. So by looking at the balance sheet, it gives me some important insight, people. My total inventory has become 7. My total fixed assets have become 2.5. That means growth in fixed asset has not been much. That means machineries are not being bought that fast. The point that Dr. Ashwini was making the other day, there could be a new machinery that you're buying. Didn't happen the way it looks like. And look at this, people. Your suppliers, the outstanding payment that you got to make has gone up 10 times. That means the company is not making payment to the supplier. Why would the company not be making payment? Oh, they must not have cash. Oh, that's why they have come for this loan. Am I going to give this loan? Oh, well, the activity doesn't look too good. Profitability is falling down. You see the profitability from 18 to 11, that's falling down. Debt has gone up. Where is this visible? Debt from 1 to 3.4. So solvency is not too good. This is a private company, so no valuation ratios. Overall, I'm going to say a no to this company. So you see, people, that's how activity, liquidity, solvency, valuation, and profitability all come together using this yellow table, pink table, and of course, a lot of ratios. And the ratios is something that I wanted to deliberately avoid because it becomes a formulative experience. You know, what is the formula, etc., etc. So there are a lot of, so we are all at Google generation. So we can always go back to Google to find out what's the meaning of ratios, etc. So people, this firm who wanted a X rupee loan will be rejected by the bank because of not doing a great activity. Sales are good, but profitability falling. A lot of investments are getting stuck at inventory, etc., etc. So there are a lot of bad reasons for doing, this thing. So, so like I said, in the interest of time, we got to kind of close the session here. I understand that we couldn't do justice to this case in the last 10 minutes, but that's where we say between the best and the worst lies something called as practical. So, so people, I stop here. So thank you very much for this amazing audience that I've had over the last 6 hours. It's been a tiring experience, but it's been a fabulously tiring experience. So I would say that I'm quite tired right now, physically, but I'm very fresh mentally. So thank you very much for giving that kind of audience. And I'm hoping that this entire finance for non-finance workshop is going to be very rewarding for you. Even if you're not going to be able to buy the shares, at least you can ask those people some questions which will make you look more informative and more knowledgeable. Okay. Anyone, any question, any query? Otherwise, we can close the session. Anyone has anything, a query or a? Okay, good then.
No, not a question. So sorry. Not a question, not a query. So I'd like to, I think, take this opportunity to thank you on behalf of all of us. I'm speaking for all of us. It was a lovely session. And I believe at this stage in life, it's very difficult for us to say the answer and someone saying, no, you're wrong. You handled our wrong answers very well. So we were very encouraged to give answers and, try giving answers. and a wonderful session. You explained it all very nicely. I wish we had more time with you. I mean, later on also, if you're conducting any FDPs, I'm sure all of us, will agree that we would like to attend that. So on behalf of everyone, it might be a little immature rather than premature of me to say this on behalf of everyone, but I'm sure everyone agrees with me. Amazing sessions. Thank you so very much, sir.
Thank you very much, Dr. Me and everyone. Thank you very much, everyone, for the kind words on the chat window as well. Lots of learning and lots of luck to you. Let's see, life is very short, and this is a full circle. So we are going to definitely meet, again in some capacity. Till then, let's sign off. Thanks, everyone. Take care.
Thank you, sir. Any announcements from the organizers, or should we leave?
So we.
You're on mute, I think.
So we can take a break as per schedule, and we resume our next session at 2:45.
Okay, sir. Thank you. And any contact numbers for you or the other
Sure. So allow me to write here. It's a long name. It's going to take a while here. And so these are the two things will help you reach me.
Thank you, sir. Because now that you have taught us a little, it becomes your responsibility
you handle it. Oh yeah.
to take us ahead. And I think I don't know about others. I'm going to trouble you.
No, most welcome.
Thank you so much, sir.
There's no, and since you've been in this fraternity, there is no pleasure greater than a student coming, with an answer, and which tells us that at least there has been a thought which has gone behind it. So I'm looking forward to such interactions.
So nice of you, sir. Thank you so much.
Okay. All right.